Hello, everybody, and welcome to the monthly market memo for the end of June and the first part of July. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to give you an update on what moved our major markets and the themes that happened over the course of June and how that relates to the beginning of July and the summer and the rest of this year. So, without further delay, let's go ahead and jump into it. Just a quick agenda items. Markets, as I'll show you, were mixed for June, but much higher for the quarter. It was really one of the best quarters in the last 5 or 6 years, and a really good start to the year still so far for our capital markets of stocks and bonds. We've also noticed a little bit of market leadership and how it's shifting away from some of the largest companies, the Magnificent Seven, as they're talked about, and to some maybe more and up and coming companies here in the S&P 500 and the rest of our U.S. stock market. We also noticed, and as you probably noticed in the headlines, but the Iran conflict is likely coming to an end, which is good for oil and gas prices. And then finally, which I think is very important, at least here in the short term, the Fed has a new chair. Kevin Warsh in the committee so far has a new view of the future of where the Fed funds rate will go. So let's go ahead and jump into, as we always do with these videos, just show you some quick market returns for the month of June. 2026. This is through the end of the month. The S&P 500 was down about 1%. International stocks were down about 60 basis points, and bonds were positive. Cash was positive. The one bright spot really has been and continues to be this for this whole year and for the quarter, small and mid-cap companies. These are smaller, as mentioned, smaller companies that you probably don't see in the headlines as much. There's definitely less Wall Street analysts covering these companies. These companies are definitely needed in every portfolio. And right now, this year so far, we're seeing why. Quarter two for everything though was excellent. This was the best quarter for a lot of these major markets since 2020, going back 5 or 6 years. We remember the 2020s; it was a crazy market. But the S&P 500 for just the quarter, second quarter was up 15%. Again, small and mid-cap companies leading the charge up over 20, and international stocks right in there about 15. Bonds were positive as well. And then so far for the year, it continues the same theme. It's just been a magnificent start to the year, not without volatility, right? Not without ups and downs, as we're always going to see in the stock market, but still double digits for all major stock markets here at home, smaller companies, overseas companies, all up over 10%, some up over 20%, as I show you. Bonds, still positive, but a little bit less than cash. I think both of those still can be an important part of your portfolio going forward. So let's jump into some of the key themes that I saw here in June. And we've really seen some leadership rotating underneath the indexes or underneath the markets, if you will. And a lot of that has to do with what our mega cap companies, mega cap tech specifically, like Microsoft, Google, Meta, Amazon, etc. They have had record spending to really go to the forefront of this AI revolution, right? To make sure that they are going to be some of the leading companies in the future, or hope to be some of the leading companies in the future, and just spend gobs and gobs of money. And that money eventually trickles down to other companies that, of course, have also produced really good earnings and produced really good returns. And their returns have actually outpaced some of these larger companies so far this year. But a lot of it has to do with spending. And we look at capital expenditures, which is just think of it as spending as a percentage of their cash flow they take in a company. As a company has really ballooned here in the last couple of years and expected to continue to go forward and into 2027, but reaching right around 75%, obviously new highs. So they are spending a lot of money that they have had on hand, but also a lot of money that they're going out to our capital markets and issuing debt for, which has increased some of their leverage ratios. Now, while this is probably good for us, the consumer, good for us as users of AI, it does reduce some of a key quality metric of companies that I like to track, and that's free cash flow. So free cash flow for these companies have an opposite value as spending goes up. Obviously, that goes further down, and that is, I think, one of the reasons why you've seen the market really shun some of these names so far this year. Just look at Microsoft for an example. It's has not had a great year. But that's, that's just in the first half of the year. It's still a really large company, still a really good sound company. Um, as we talk about this, markets typically throughout history have rewarded these high quality firms that have a lot of cash on hand, continually buy back their shares of stock, good return on their assets, low leverage ratios, and that's really kind of flipping on its head right now. Some of these metrics are eroding, as I mentioned. Free cash flow is going down, leverage is going up, typically not great for a company. Now, they still have a lot of cash on hand, but you've seen the market try to get ahead of this. So far this year, the S&P 500, as I mentioned a couple slides ago, is up about 10%. Still really good returns. But if you look underneath the surface at just the seven companies that encompass that Magnificent Seven, they're actually down 5% through close to the end of June. And that is Meta, Microsoft, Amazon, and Apple, and some of these other firms that get mixed in there. But for the most part, it's the largest companies in the world and in the United States. Just has not been a great start to the year. But I think this is healthy as these quote unquote generals fall. New leadership is picking up the slack. We've seen AI memory, AI semiconductors, some of these names like a Micron, like Lam Research, some of these areas and companies have done fantastic so far this year. And if you just exclude out those top seven names, you're actually up over 15%. So it's important to look at this of what's going on underneath the market and just see what the market is telling us and where maybe the future may be going. Now, there's no reason to say that you need to completely abandon any of these large names. It's just more of a healthy bull market as we see it rotating into other areas of the AI ecosystem, if you will. Going on next, we talked a little bit about, and you've noticed in the headlines, the U.S. and Iran war is hopefully coming nearing an end. They have signed a memorandum of understanding between the two countries. Hopefully, will open the Strait of Hormuz. And if you remember, this is really what has caused the bottleneck in a lot of oil prices. If ships cannot go through that strait, oil prices have moved higher. Now we've started to notice a little bit of an uptick in ships coming through the strait again. Now, this is those bars that I'm showing you. There's a lot of bars going higher. There's a lot of ships going through. If there's not that many bars, there's not that many ships. So the yellow line I drew there is roughly where when that memorandum was signed. And you've seen a little bit of an uptick in ship activity. Now, so this is important. We show that just the 7-day moving average of ships going through the strait has increased. Again, that's positive, but we're nowhere close to where we saw last year as far as the average of ships going through, which was right around 100. And right now we're less than 20. So we still got some work to go to continue to see this. I think oil will remain volatile because of this. But so far, market is always forward looking. Oil and the price of oil and the price of gas has come down drastically since this in anticipation of this, right? So whereas oil gone, Brent, which is really mainly overseas in Europe, and WTI, West Texas Intermediate oil, here in the United States, has both moved down in tandem. They peaked at around 120, 125. And now they've moved down closer to the 85 range and kind of settling in the 70 range is where I looked at it this morning. So it's just been a welcome sight, I think, for those of us that are, paying those summer gas prices, because as oil moves down, gas prices should move down as well, maybe with a little bit of a lag, of course. Supply and demand plays a part there, but gas prices nationwide are less than $4 a gallon right now. And here in Nebraska, they're much less than that. So just a welcome sign as we continue the summer driving season. And hopefully this skirmish, this war in Iran has kind of come to its end, and we can move forward with some other key themes for the rest of the year. Now, in turn, with oil moving lower, this has actually had a positive effect on inflation, where we think inflation will go. We don't, in the past, it's always a rear view looking mirror. You've seen inflation actually move higher. but we're always trying to look forward, and the market is now looking at a 5-year inflation number 5 years from now at about 2.2%. This is actually lower than where we were at the beginning of the year, which is right around 2.3. And of course, it's much lower than the 2.4 number where we saw at the beginning of the war. Obviously, it peaked at around 2.7 in the height of the war there, but it's fallen drastically as the price of oil has fallen drastically. So this is really important. If inflation stays high, it can erode your returns just as an investor in general. It can cause a higher discount rate for stocks to try to beat, which makes them more volatile and can have them become a little bit more choppy for future returns. It also hurts your bond prices as well as bonds have fixed investments, and if inflation keeps moving higher, that's going to hurt them more and more. So inflation coming down is going to be key. Now, it's also going to be key as I wrap up here to see where the Federal Reserve goes. We have a new leadership. We have new Jerome Powell stepped away. He's still a Fed governor, but he stepped away as the chair. And we have Kevin Warsh stepping in as the new chair, appointed by President Trump. They have looked back at the past data and really they saw inflation moving higher and they started to kind of change their view on that. I wanted to paint this picture for you here as we end this call. But we've noticed back in March when they released their survey, about 12 voters said we expect rates to be lower at the end of this year. 7 said probably unchanged. 0 expected rates moving higher. 3 months later, post-war, in the midst of war, inflation moving higher, this has really flipped on its head. We see basically a split right now with 9 participants voting that they believe the federal funds rate should be higher than where it is right now, and another 9 saying unchanged or lower, only 1 saying lower. So it's going to be interesting to see how this shakes out over time. Right now, we do not expect a Federal Reserve rate hike, in July. However, September will be on the table. And as I mentioned, several months ago, the Jackson Hole Symposium will also be important to watch for Fed commentary. Now, they say Kevin Warsh doesn't like to give out a lot of hints about where things will go, so we'll have to see how much commentary he will actually provide. But for now, they are very much focused on fighting inflation as the jobs market has really held in there pretty well. Unemployment actually came in lower than where it was a month ago at 4.2%. So to finalize this and put a pin on this, if we look at kind of the March expectations for the federal funds rate, again, this is important because the mortgage rates, housing affordability, all kind of stems on this. The bond market, the equity markets look at the federal funds rate for clues on where it'll be in the future and then adjust from there. We're at about 3.63% on the federal funds rate now. In March, they expected the end of the year to be at 3.4. And in June, we expect the end of the year to be at 3.8. So this is a drastic change. You saw bond markets really react in real time to this, but have kind of settled back down. Nothing too crazy so far in the bond market. So amidst all these key themes, it is important to stay diligent and stay diversified, of course, to a good mix of stocks, bonds, and cash. And we just really appreciate you taking the time out of your summer to watch this video. And we do appreciate and approach the management of your complete financial landscape very seriously. As a trusted steward, advocate, and confidant, we are completely committed to you, the client. You can always reach out to us on our telephone, email, or on our website where there's a lot more good videos and key blogs out there if you want to stay connected. Of course, reach out to your independent financial advisor here at Retire Path, and he or she can help you out there as well. So again, thanks for watching. We hope you had a fantastic Independence Day holiday and are going to have another fantastic summer here in 2026. Thanks again, everybody. Take care. Bye-bye.